On today's episode, we're talking about what every company, big or small, is talking about these days, profits. That's right. Do you remember those? The honeymoon's over, sellers, and you must be driving more cash to your bottom line to get to that ideal exit. Stay tuned, because our guest today is the most knowledgeable person I know when it comes to getting your Amazon financial house in order. Welcome to the Day 2 podcast. Today's topic, profitability and profitable growth on Amazon, with someone who's as snapped in as anyone in our space, my good friend, Tyler Jefcoat. I'm Jason Boyce, founder and CEO of Avenue 7 Media and host of the Day 2 podcast. Tyler, don't call me Jeff Jefcoat, is the founder and CEO of SellerAccountant and leads the Sellers Roundtable, an exclusive mastermind for 7- and 8-figure sellers. Prior to this, he built an amazing 100-plus employee firm in the home healthcare space and exited. The best way I like to describe my friend Tyler is that he's the CFO, controller, business shaman, and friend of Amazon sellers everywhere. Tyler, welcome to the show. What's cooking?
Man, Jason, what an intro. Thanks, buddy. It's good to be here. Seems like a little bit of everything is cooking. This is, the beginning of the year is when accountants are popular. We're not popular most of the year, but this is the moment when we get a lot of attention. And the topic of how do we drive performance with our brands when it's not bull market, tailwinds, it's getting a little more challenging, but it just makes it more interesting because it allows us to differentiate, as sellers and really make a splash. Not everyone's going to do it. Some are going to fail.
I've had a lot of experience over my 21 years plus in e-commerce, Tyler, and I've worked with a lot of CFOs, a lot of accountants, and a lot of controllers. And, I always appreciate folks who get the numbers, but more importantly, get the business side of things as well. And you fall into that category, and it's why we refer a lot of our clients to you when they're trying to figure out, their financial house. Have you always been in that way? Was it hard for you in the beginning to get to that business side, or was it just your entrepreneurial experience that got you there?
The way that you get to where I am is to feel like an absolute square peg in a circle hole for the first half of your career, right? So I went through a top 5 accounting program, but just hated like half of it because I wasn't wired like most of the other guys in the class. And yeah, I'm really grateful for my dad, who was like, bro, you're in a top 5 accounting program. You're not quitting. Let's finish it. Let's get the degree. You're going to be thankful. And so I pivoted away from accounting because I don't like accounting for accounting's sake. Isn't my favorite thing. I'm not super detail oriented. I'm a visionary. I'm a strategist. But what's really funny is it kind of always seems to happen in life is really, really quickly into my career, I ended up getting to join a startup to build this healthcare company. And my goodness, was that accounting background useful as we tried to navigate growing, from, like you said, 0 to 100 employees in 4 years. And yet I have an accounting degree and I have a finance focused MBA and I was a banker for 5 years. If anyone shouldn't crash a business financially, it should be me. And I did quarterly for the first 3 years of our explosive growth. I couldn't handle it. And it's because having an education in numbers is not the same as having a visceral understanding of that fetal position, 2:30 in the morning, CEO, everything's going to crash and burn kind of feeling. And so honestly, I was grateful to get the background, and then I just made enough mistakes that now I'm like, oh, that's why you have to study cash flow. It's not like a game. This isn't a spreadsheet. It's a real thing. And so getting to kind of employ and learn from my own mistakes for our clients has been great. And by the way, I want to say this, I'm not a great controller. Like I'm a pretty good CFO, but thank goodness for my business partner and the other 20, plus people that are doing bookkeeping at SellerAccountant. They're really, really good at the traditional accounting stuff. And I thank God every day for my accountant. Like I need a bookkeeper. I need a CPA that does things right. And then you also, and you alluded to this, Jason, you need people that understand how to connect the numbers to choices and to how to drive the business. And I think that's probably my superpower.
Let's talk 2023 a little bit. Okay. There's a lot of chatter in the seller community about increasing fees. I mean, I think they raised FBA fees alone 2 or 3 times last year. Now they're creating a bidding process for getting additional storage. You'd think having a successful selling product would be enough without having to bid for more space to get you more space. But, if you look at the fees, I'm always talking about this and looking across our 100 or so clients, Tyler, that about if you're doing things the right way, and there's a lot of category differences sometimes that changes the ad spend, it's about 45 cents of every dollar that you get on Amazon goes to Amazon, not to you. And then you got to pay for the cost of capital and the inventory and all of the stuff required to get that product made. Is that still the case, or is that outdated now? What are you seeing in terms of how much money is going to Amazon versus sellers for every dollar sold on Amazon these days?
Actually pretty close to accurate, Jason. I mean, I think we did a pretty detailed study for 2019 and 2020 that showed a tad better than that. I think it was like 43 cents, but across 200 million in sales, right? So it was a pretty good data set. And, if you guys are trying to visualize what that 43 cents or 45 cents is, about 15 points in your commission, about 10 points in ads, and then the difference was just that FBA fee. And I think you're right. We haven't finalized 2022 study, but just strong anecdote is that because FBA fees increased twice last year, there's no doubt that 45% number that you quoted is correct. And that just makes it, we still got to keep the lights on. We still got to secure our product. It's, there's only so much scale we can get being a solopreneur. We're gonna have to bring in a team. And so how do we do this? And it's just put more and more pressure on products that aren't premium profitability. Under the guise of democratizing the real estate on Amazon, they create a bidding process for us to buy our way into selling products. And under the guise of doing something similar in the fulfillment world and making it to where we're not warehouses, we're fulfillment centers, we're now going to make a bidding process for real estate to store our products. That's a recipe for if you were to ask me, if you and I were coaching Amazon or saying, Amazon says, how can we create a scalable process for ensuring that we always improve our margins as Amazon? God, that would be it. The what they're doing is the way to do that. Yeah.
The parallels there are kind of in the PPC space, Tyler. And I remember back in the day when I was doing Google PPC, nickel a click, we made a lot of money at a nickel a click. And then before you know it, it was $5 a click. And then when they introduced Amazon sponsored product ads, it was the same story, right? I was like, oh crap, I've seen this movie before. It's 5 cents a click. And everyone was raving about how it was helping their organic ranking and their sales and everything. And I was like, stand by, because it's not going to stay at a nickel a click. And that's my concern about the bidding process. And I just, it's just another scenario where Amazon is not as good as you and your team, Tyler, at identifying, how much space you need, what your sales velocity is. And they've got a bad system. And instead of fixing it to the benefit of sellers, what it seems like they're doing is finding it as an opportunity to make more money and enter in another bidding process where the cost is just going to go one way, up.
There's a public relations PR element of this. Amazon has wanted internally to raise these FBA rates for several years now, but you can't do a stock split or post record-breaking 2019, 2020 profitability and get through you're going to end up in front of Congress if you raise your FBA rates. But give us a good supply chain crisis where the end of 2021 resulted in a $4 billion loss for that side of the business. And then all of a sudden you unleash what Amazon had wanted to do anyway. And so in some ways, the reason that Amazon's always been cheaper than a 3PL for the most part is that they were kind of propping us up. In some ways, we may have selected products that were close to being viable, and Amazon propped them up to where they were viable. And now some of those props are kind of being removed. And I say this, you and I represent sellers, right? We want the little guys to win, but the heat is getting turned up where we're really having to focus on a viable marketing wheel and a viable sourcing wheel. And it's harder. Let's just call it what it is. It's more difficult than it was.
That all being said, I want to go back to something that you posted. I think maybe it was you did a YouTube video on this. If you look at gross margins, Amazon versus Shopify, you're probably looking at a smaller gross margin on Shopify. But if you drag that down to the net revenue and you're doing a DTC business driving traffic, the net revenue, when you compare Amazon sales to Shopify sales, is actually better in many cases. Can you unpack that a little bit? And maybe you can reference your YouTube channel. And I know you've got a podcast too, so I'd love for our listeners to hear it. And now's your opportunity to shout it from the rooftops.
Yeah, well, thank you. So return on podcast instead of return on investments, return on podcast is our
I love the name.
Check it out. Thank you. So I think, Jason, what you're talking about there is if you run a P&L and then you actually add in those direct advertising expenses, oh, by the way, and those outbound freight expenses, right? So if I'm doing a Shopify D2C site, okay, I'm going to pay PayPal a 2.9 or 3% kicker. I'm not going to pay 15%. Okay, 1 point Shopify. But here's where you really get in trouble is my cost to acquire a buying customer on my website, unless it's my core competency, is still like 5 times as high as it is on Amazon. And so for the sellers out there that have products that are more relationship based, you have a product that is, and by the way, this is a moment to be honest with yourself. If I'm selling a more commoditized or algorithmically driven kind of product, I don't want to waste a lot of resources trying to be direct to consumer, because I'm never going to get the same ROI on Shopify that I will on Amazon.
There's no differentiation. There's no difference margin in there.
Yeah, I'm selling glass jars. Use the algorithm. Find a way to cut my costs. If I'm selling like lifestyle sleeping bags or something like that, that's like, man, I like Patagonia. You know, you love a Patagonia. It's a brand. And so I think to your point though, like Amazon, although we talk about the 45 cents of every dollar going to Amazon, because of how many eyeballs, they're so dominant still on the buyer intent. The buyer that clicks on your listing in Amazon is so close to the bottom of the funnel where they are ready to pull the trigger and buy, that Amazon is just creating a tremendous amount of value. And so they get to capture some of that value in fees and the PPC. But let me put it this way. If you're successful on Shopify, you almost certainly need to be on Amazon also, not just defensively to keep bad guys off your listings, but because if you can make it on direct-to-consumer sites like Shopify, the contribution margin of going Amazon, unless it's a really weird product that doesn't get through some kind of hazmat or something like that, most of the time the economics are going to be better or equal going to Amazon still, even now.
On a net basis, right? You may freak out because that gross margin, especially if on Amazon you're including your advertising fees above the line. Do you recommend that? Do you see that? How's the gross margin calculation on Amazon versus that gross margin calculation that you see with your Shopify DTC folks differ?
If you look at generally accepted accounting principles in America, for publicly traded companies, you have to put advertising expenses down below the line, and storage has to be down below the line, kind of in your normal expense area. But if you're a sub $25 million company and you're closely held, you're not publicly traded, the IRS doesn't care. And so what we're realizing more and more as an accounting firm is our accountant types get really bent out of shape out of trying to hit rules that don't really matter to us. And so we're officially changing our chart of accounts, Jason, across our entire client base over the next couple months to clearly, if you can imagine your cost of goods sold section, it's going to have product cost of goods sold. It's going to now have inbound logistics, outbound logistics, marketplace and selling fees, advertising expenses, and then kind of an other category. And the reason is we want gross profit to mean real gross profit. We want it to mean, if I'm looking at Amazon versus Shopify, that I can really capture. And by the way, one of the expenses that's really different is, okay, FBA fees have gone up. You paying UPS to ship a product across the country is still normally more expensive. And so making sure that we're comparing apples to apples, all of those Facebook ads that didn't convert, we got to make sure we're counting those, and all of those UPS bills to ship the product across the country. And so to your point, I think once you go full apples to apples, again, it's not always the case, but in most cases, unless you have a killer influencer game and really have the ability to generate your own funnel, most of the time Amazon is going to have better economics and should at least be a part of your playbook.
So that chart of accounts, that's specific to Amazon, or are you also transitioning all of your DTC clients to do the same? Because it's different, right? If you have a warehouse and you've got staff that's picking, packing, storing, and shipping, those where do those line items go if you're brand X selling a premium brand on your Shopify store? How does that chart of accounts
That's a great question. As soon as you start owning the overhead, like I now have to sign a lease for my warehouse, and I've got Bobby and Jimmy and Susie who are salaried or hourly employees in my warehouse, all of a sudden your ability to kind of associate those expenses per unit becomes a little harder. So I think for me, if you're looking for the absolute simplest rule of thumb, it's, could I somehow get the data to, if I wanted to, I may not even want to chase this down, but could I theoretically attach this data to a particular unit? And Amazon makes that 100% a yes. And actually most Shopify, especially if I'm contracting with either a 3PL or say like my FedEx account, or I'm using like ShipStation or something like that, again, that gives me a level of variable visibility that I could make the argument to move it and kind of capture it in that true contribution margin level. But to your point, yeah, as soon as I'm paying insurance and overhead expenses and salaries, it's going to make it more challenging.
Below the gross margin line, and they're going to be a lot more than what that FBA fee is potentially and
And by the way,
freighting.
manufacturing is the same, right? So how many sellers out there are buying components and are then building the kits? Okay, how do you do that when you pay Jimmy an hourly rate and he's the one constructing your final kits? If you're in those cases, you're not going to be able to use a standard chart of accounts. You're going to be using, we do that. We just have to be more customized for those more specialized sellers.
God, that's such good information, because I tell you, we talk to clients all the time, and I think we worked together on a client. I love this client, and they came and they said, I'm not making any money on Amazon, right? And I said, yes, you are, and we're going to work with Tyler, and he's going to show you that you are. And I think you came back and you said, we're not going to name the client's name, protect the innocent. But I was shocked that you came back, you ran their P&L, you did it on an ASIN level, you did it on a total level, and they were in the top 5% in profitability as an Amazon seller, which they loved hearing, by the way. Thank you, Tyler.
Sure.
But here's the thing, Tyler. Here's the thing. They have spent 20 years, close to 20 years with a B2B business where they have a wholesale price, they have a really fat margin, they send that out to their distributor or their dealer network or to their retailers, and they make really good margins. So for them, they were saying, look, when I compare my gross margin on my .com when I compare my gross margin on my B2B, Amazon is a really unprofitable channel. But talk a little bit about the differences, and should all of this profitability be put into one bucket, or should there be different verticals with different expectations in terms of overall profitability, Tyler?
Yeah, so this is a really, really important discussion, Jason. So let's say everybody has a finite pile of resources. This is where it starts with. I've only got so much fuel in my tank, cash. And so I'm trying to decide whether to deploy that cash to Shopify versus Amazon versus my wholesale model. And you can apply the exact same logic to, I'm trying to decide whether to invest in the green variation versus the blue variation, if on a SKU level. And here's what has to become a part of our playbook as CEOs in this business is we can actually compare apples to apples by doing what's called a return on working capital analysis. So just theoretically, for every dollar I beg, borrow, steal, invest, put into this business for 12 months, what is the actual return on investment for that dollar invested? And what I found is for a lot of wholesale accounts, especially if you're selling to the big boys like a Walmart or a Target's stock cash terms are 90 days. And that's after you get enough volume to beat them down from 120 days. And so if you think about having to buy your inventory on normal seller terms, or maybe you're finishing manufacturing it and you sell it to, say, a Target, you might feel like your margins are really high, but you might be waiting 6 months to get paid from when you actually bought that inventory, or maybe longer.
Not to mention the markdown money that they're going to come after you if you're selling at Walmart or Target if the thing's not moving at the rate they thought it was going to.
That's right. The credits, the clawbacks. That's right.
The credits, the allowances, the clawbacks. Yeah, exactly.
And so if you take profit, take a true contribution margin kind of after ads, after Amazon fees, and divide it by the amount of cost of goods sold for that period of time, that's going to give you a really important metric called return on inventory investment. Think about it like baseball. That's my batting average. What's my statistical effectiveness every time I get to turn my inventory? But that's not enough. I got to then know how many times per year I'm turning my inventory. So I got to know my batting average, and I got to know how many at bats I'm getting per year. And so if I only turn my inventory once a year, let's say really easy numbers. Let's say I have 100% return on investment, but I only turn it once a year. My annual return is a 1.0 or 100%. That is not really that good. You might feel great on that turn, but guess what? The guy that's only getting a 50% return on investment that turns it 6 times a year is outperforming the hell out of you because he can get the velocity on that inventory. And so take each of your channels, calculate, and this is hard, by the way, because I might make a deposit in inventory before they manufacture it. You have to try to calculate your actual cash cycle, so that you can determine how many times per year roughly do I get to recycle my dollar. I don't have to go borrow another one. I've already got it because I got my money back. And it doesn't have to be exact, but if you were to basically calculate those turns per year, multiply it times the return on inventory investment, which is just profit divided by COGS, that would give you a normalizing metric. I could compare every sales channel with each other. I could compare every ASIN with each other, and I could realize right away, oh my goodness, that one, I never need to stock out of that one. That one has such an unreasonably high return on working capital, which is the true metric, that if I'm mortgaging the house before I stock out of that one because the opportunity cost of missing it is so high. Flip side, you know what? With my bottom 20% ASINs, I'll order it when I get around to it because the impact of each turn is so low that I don't want to be sitting on a year's worth of inventory. I would rather fall off the rails on the side of stocking out because the opportunity cost is relatively small. And so I can do that for wholesale versus Amazon. I can do that for direct to consumer versus Wayfair versus whatever you want to do, that kind of thing.
Ladies and gentlemen, this is gold. Listen to this, hit rewind, listen to it again times 12. And because this is exactly the information you need, especially you younger sellers. And Tyler, I want to back up just a little bit for some of our newer sellers who maybe don't understand what an inventory turn is. The way, in my layman's terms, it's, if you buy 1,000 units, it's how fast can you sell through those and how many times can you sell through that 1,000 units over a 12-month period or over a period of time. What's your definition? Did I get that right or am I a little off?
Days of inventory, just for those of you kids from algebra class, days of inventory and inventory terms those are algebraic inverses. Whatever's more convenient for you. If you're like, all right, how many days of inventory do I have in stock? Well, I could just look in my warehouse and say, okay, I've got 100 units. I sell 10 units a day, right? That means I have 10 days worth of inventory, which by the way, if I have 10 days worth of inventory, that means I turn it 3 times a month, which means I turn it like 36 times a year, right? So the algebra can be calculated either way. And what we're trying to wrap our heads around, Jason, is how long does my cash get stuck before I get paid back from Amazon? And by the way, quick hack here. This is worth the price of listening to this episode. If you can just get 2 weeks of extension on paying your suppliers, you could solve like 60% of your problems. Like if I could give my sellers just one gift, it's to maybe fly to Asia or kiss babies, drink sake, do whatever you have to do to get the kind of relationship where you can ask for an extra 30 days to pay your suppliers. You'd be shocked if I could show you graphically the impact that has on helping your dollar stretch further. Every CEO in our space needs to allocate a couple of hours a month to nurturing, back rubs, massaging these supply chain relationships.
If I could dumb this all the way down, Tyler, what I'm translating here too is velocity matters. Size doesn't matter as much as velocity and speed matters if I had to narrow it down, right? And so is that also sometimes the way brands and sellers misconstrue profitability on Amazon? Like your margin may be smaller, but damn, you're turning that stuff 12 times. And that's a much better story in terms of profit dollars than if you're turning it 2 times with Target, and then they're coming back and giving you death by 10,000 cuts with every allowance they hit you up with after the sale purchase. Am I speaking truth here? Help set me straight, Tyler.
Well, so a couple of case studies. You're talking about a client that we've had together in the past where on paper they made a profit. They're like, I can't believe this. Why do I not feel richer? I want to feel richer. And the reason they're not feeling richer is that their inventory kind of bulk expanded quicker than their profitability. And as a result, they made a paper profit, which is so frustrating. Don't you hate when accounts tell you made money on paper, but your bank account is freaking smaller, right? That kind of thing.
And so when the tax man comes knocking, Tyler, when that happens, that's not necessarily good.
I still want my cut of the whole profit. I don't care that you don't have the cash, right? And so case study 1 is I'm really profitable, but when I really analyze my business, my inventory velocity is too slow. And the best thing I could do for my business is probably not to hassle over 1 more percentage point on my tacos. The best thing I can do is to try to get an extra month or 2 supplier terms or liquidate some bad variations that aren't working or do something. Maybe when I do the math, I realize, oh my gosh, paying $10,000 to have a consultant help me set up an inventory management tool. Wow, that's all of a sudden feeling like a no-brainer because it helps me have to order lower, or wait longer to rent. And so the opposite is some of these wholesale arbitrage guys in particular, Jason, would you empathize with those guys too a little bit? Where they are sometimes the richest guys at the party. Like you don't realize it, but sometimes they're like, my margins are trash, man, but I turn my inventory 17 times a year and I drive a Lamborghini and things are okay because I've got good technology. And so the key for me as a CFO is to not try to give the same advice to those 2 people. And so there are very different business models as an Amazon or e-commerce brand, and know thyself and then execute your mission instead of trying to become someone else's mission. I think that can be actually a fallacy of going to some of the larger national conferences. You go to a session, you might hear a guy like me talk or like Jason talk, and you're like, wow, I'm just the biggest jerk ever. I need to go back and retool everything. The question that they fail to ask, maybe I fail to ask, I don't know, is wait a minute, let's figure out who you are. What is your actual niche in the market? And if that niche is to sell glass bottles, we're not going to direct to consumer. But you know what we are going to do? We're going to fly to Colombia and try to find some diversity in your supply chain so you can lower your lead times. And then vice versa. If we have outrageous margins on our products, guess what? We're going to go ahead and try to hire some influencers and spend money to get multi-channel going, because now our competitive advantage is on the product. We've got to find a different market to sell it on. And so just know who you are and build your strategy around it.
I love that. And, Tyler, I've been guilty of this in the past too, because I was never an RA as a seller back in 2003 when I started, but I was a drop shipper, which is kind of similar, right? We'd sell stuff and then send the order to the drop shipper and they would deliver it to the consumer. I'd always kind of looked down on some of those retail arbitrageurs. And then I had to create my own brand because I just was tired of Amazon kneecapping me. And then I started to look down on resellers. But you're right. I got contacts or friends who are billion-dollar companies and they're just a reseller because they understand exactly what you're talking about. And I got other contacts and friends who are retail arbitrageurs, God bless them. And they're doing these super fast turns and they don't have a whole lot of overhead. They don't have to design a product, QC a product. They just get the product. They buy for pennies on the dollar and they make a ton of money and they turn it fast. You're right. It's like, figure out who you are, stick with who you are, and become the best in your niche that you can be. I think that's great advice from you, Tyler. And again, this is not your everyday CFO, folks. This is a real entrepreneur, and you're starting to get a flavor for it, how he thinks as an entire business, as your whole business, and getting to know you first. So, great stuff, Tyler. I really appreciate it. I know that you're really snapped into what's going on in the aggregator business, and we've had a few episodes talking about, what's going on. It was kind of boomtown, and now it's not quite boomtown. And I really want to talk about this and approach this topic, Tyler, from the perspective of sellers. Most sellers that I know aren't looking to hand this seller business down to their children or their grandchildren, right? It's just not that kind of business because it's such a hard business to be in and it's exhausting. One thing you don't have to worry about on Shopify that you absolutely have to worry about day in and day out on Amazon is Shopify is not going to take your listing down. You don't have to worry about that. You may get a letter from the FTC or the EPA or FDA, but you're not going to get your listing down. So it's really hard, right? Our mutual friend, James Thompson, says it's like an ER department and you never know what's coming through that door. That being said, back to my, back to the original comment, the Amazon aggregator space. It was boom time for sellers to sell their businesses a couple years ago when Thrasio went out and raised billions. And then there's tens of billions, raised in the space. Those exits looked really, really good. What are you seeing on the street in general terms, where the margins and the exit valuations were and where are they today? And then lastly, what are you recommending for a seller who's like, man, I'm on my last leg. I'm tired. I want to prep this business for sale.
So I'll take those in turn. So yeah, you guys saw this 2020, 2021, unbelievable amounts of capital flooded into our space and demand spiked. So it was, it was the perfect storm. We had a lot of smart money tired of Kohl's and Belk's and traditional retail because of the pandemic. And because of how much e-commerce had predictably grown, coupled with the fact that all of a sudden the pandemic made grandma go to Amazon, right? So the buyer profile shifted. Think about the arc of this story. Billions of dollars, like you said, Heyday, Thrasio, Perch, and all of these Razor Group, all these other guys raised all this money, but they were primarily purchasing assets with like Wall Street hotshot MBA guys. And they were not really that good at diligencing these assets. That means to like poke under the hood and make sure they knew what they were buying. And so you and I, Jason, along with our clients, started feeling this like, what is going on here? People are historically getting a 3x kind of multiple on profit, so 3 times your annual profit as a multiple. And now all of a sudden they're getting 5, 6, 7, 8, sometimes X multiple on these businesses. What is going on here? And so the prevailing wisdom had become sell 5 ASINs, sell only on Amazon.com, have 2 VAs, have no infrastructure, and optimize around being gobbled up by one of these roll-up aggregators so you can cash that big check and get out. And so what I found is our sellers that exited early in 2021 or even in 2020, oh man, they were so happy. Those guys made a killing. They had great multiples. For the most part, they got paid, even on the earnouts. But as these businesses matured, and I don't want to get too technical here, but there were 2 promises, Jason, that these aggregator executive teams were making to the Wall Street investors. One, we're going to be able to advertise more efficiently than Joe Seller. Joe Seller's a smart guy, but man, if we got some horsepower in our office here, we're going to be able to be better. They were not better. And then the second thesis is we're going to be able to deploy our cash to buy inventory. We've got the muscle. Hey, we can go to the factory in Asia and we can use our bulk pricing power to get unbelievable terms. But they didn't. They failed because the complexity of the inventory was so incredibly steep. You think about like Thrasio. At one point, I think they had like 120,000 unique ASINs.
And no brand. Almost no brands, right? They were all really commodities in some level.
Yeah, and so managing that complexity, and it wasn't just Thrasio, it was for all of them, was just unbelievable. And so what we saw last year, now fast forward to 2022, and oh no, demand just kind of gone back down to normal a little bit. Interest rates are going up, so it's harder to get a loan. You think you and I bought too much inventory at the end of 2021 because we didn't want to stock out and oops, now we have too much inventory? The aggregators bought way too much inventory at the end of 2021. Check this out. From 2021 to 2022, on average, across our entire population, sellers had an average of 90 additional days of inventory on their balance sheet. So what that means, friends, is if you pull up your profit and loss statement and look at your cost of goods sold for 3 consecutive months, that's the amount of cash not sitting in their bank account anymore because it's stuck
on the shelf
in their supply chain because they had longer lead times and they were scared and they were buying up. So the aggregators did that on steroids with institutional money. And of course, their investors got mad, right? And so when investors get mad, our guys, so you and I were thinking about this from the perspective of sellers, the sellers that sold like a year ago, oh, they're so mad right now because they're not getting those earnouts and those subsequent payouts that they were promised.
That's really great. And you're right. They made this promise. We're going to get lower to the investors. We're going to lower our costs. We're going to bring my resume from all these big fancy Manhattan consulting firms to these sellers who don't know anything about anything, right? They're so not smart. We're going to do so much better because we got a great resume. And they learned really fast that doesn't work. You know, you need to get your sleeves rolled up. You need to be introducing new products. You need to be developing brand. You need to be getting in there and fighting the fight that all these great millions of Amazon sellers do every day. And I don't know that they were ready for it in many cases. It's such a good point. It didn't occur to me that you're right. The 2022 folks who sold are not getting their earnout now because everyone's fat on inventory. Stuff that was supposed to be, especially if you're seasonal. Oh, God help you if you're seasonal. You're probably going to sit on that inventory because you missed your selling season. And now you're going to sit on that stuff for a year until the next season rolls around. Ouch.
A really like classic case study would be, I sold my brand, the aggregator took over. They somehow have way too much inventory, plus they stocked out of my 2 hero SKUs at the same time, right? And
yeah, right.
This might have been some arrogance on those guys, but to be honest with you, this is the exact thing I articulated with myself. Like when I started my first company, I had the pedigree until I got in the trenches, bullets started flying, and I had 50 grand a week in payroll. And I was like, oh my God, I have no idea. And so I think in some ways, this is just the natural evolution of turning a sophisticated education into a practical leadership skill set. We give these guys a hard time and they deserve a hard time. There's a lot of money that's going to be lost, but
there's some good ones out there, Tyler. You and I both know it. There's some good ones that learned fast or came to the table with the right mindset to begin with. And those are going to be the ones that are going to be around over the next 10, 12 years or 3 years of them when they get their big exit or they go public, whatever that role is.
There's no doubt about it. And I think that's the thing to take away here is that guess what? Growing pains happen. The money was so cheap that there was a bit of a feeding frenzy 2 years ago. Now there's a little bit of a who are going to rise to the top as the actual executors that can get it done. Some of them are going to.
You did a great job of outlining what was and what those multiples look like. And what are they now? What are they in the beginning of 2023 compared to where they were before that you're seeing?
Well, I am talking about multiples of earnings. Normally in e-commerce, we use SDE, sellers discretionary earnings. So they're going to give you some add backs, but they might have doubled from like kind of a 3 to a 5.5, 6. And now I think they're kind of reverted back to that, maybe even 2.75-ish X multiple for these same kind of businesses. I guess the bad news is that if you are one of those sellers that's really feeling some just burn and grind right now, it's just not a great time to sell unless you have a premium offering. Because I will say this, there's still enough in the investment where they call it dry powder. There's just still enough cash sitting out there that if you are one of these businesses that have just premium margins, you've got great IP, you've got great relationships with your customers, there actually may be a bidding war for your business still because of the power, but normally that means you've got a very viable direct-to-consumer and some additional channels in addition to Amazon. So right now, you go to market, you're probably going to get 2 to 3x. It's a quick case study that's a sad one. Friend of ours, just a SellerAccountant, not even one of my clients, got an offer from one of the aggregators of like 4.7x SDE 2 years ago. Pretty good offer. She thought she could get more, said no, I'm not going to take it. And I happened to advise a board of a smaller aggregator that just, I think they're closing a deal at 1.8x right now on that exact same business team.
Ouch.
And so here's the investor advice is, you always hear this, but it really is true. You can't time the market. What you and I need to do right now is we need to know what our objective is for this business. Because Jason, like you said, most of us are kids, even for SellerAccountant, by the way, my kids are probably not going to take over SellerAccountant. Maybe they will, but statistically, they're probably not. And so I need to come up with an objective for this investment. So I know my number and I know what it's going to take to get there. Because if the market turns rosy again here in a few years and someone gives me my number, I need to take it and I need to get out because I know who I am and I know what my number is. And so that kind of goes to the advice bit, which is right now is the time to build your infrastructure. If you're well capitalized, it probably is time to invest in a second channel or a higher margin offering. So if you tend to live in an AOV of $50, you may look at an $85 or $100 AOV to try to go upstream a little bit. If you're one of the sellers that's really struggling for cash flow right now, now's the time to hit a timeout and get my accounting in order, understand my cash cycle, and find ways to lean up that inventory that ballooned and bloated last year. Because either of those things, whether it's getting my house in order or expanding strategically, either of those things are going to give you more enterprise value in 2 years when it's time to exit.
God, I love that advice. Know what your objective is. Build your infrastructure, get a handle on your cash flow. What's your inventory turns? What's your return on working capital? And guess what? With interest rates what they are today versus 2 years ago, you better be having a pretty good investment on your working capital because the cost of capital is much more now than it was. I love your advice about going up market on your AOV, on your average retail value. Find some stuff that's more premium, that's more differentiated, that's branded, build your brand, sprinkle that pixie dust all over your stuff, differentiate it, and get ready for the good times to come back again at some point. And they will, right? I mean, Is there any doubt, Tyler, that the good times and the good multiples will come back at some point in the future here?
I have no concerns. Of course it's going to come back. And here's why. Yes, the e-commerce boom of 2020, 2021, we're not growing at like 50% year over year right now, but we're right back to growing 13% year over year. In other words, our category is expanding aggressively. That's not going anywhere. Amazon and Shopify and these other channels are still, I believe, like one of the most lucrative and exciting ways to build a business for yourself and for your family. And honestly, I guess the way that I try to frame my mindset here, Jason, because by the way, like multiples for your business and mine are different now than they were a year ago also. Like, so let's just be real. Right. Like sellers and brands like struggle. Well, guess what? Us companies that serve you guys are like have the same headwinds that you guys have. And so my mindset as a CEO is no. But this is when we make our money is right now. This is when we go knee deep into implementing a system like Traction EOS or something like that. This is when we use the pain of some financial tightness to hold our team accountable and make sure that we only have the right people on the bus. This is the time when we get organized and we decide that this isn't a hobby anymore. It's an adult venture that's going to grow. I don't know if the sellers are like this. I'm going to tell them myself here. 2020 and 2021 were amazing years for SellerAccountant. 2022 was a okay year. And the reason is, the market changed, but that's not the real reason, Jason. The real reason is that I executed better in 2020 in the first half of 2021.
Our 22 was better than 20 and 21, but because of a combination of things, including we spent a lot of time and energy on, what was your first thing you said? Building out our infrastructure and building out our systems and assigning our KPIs for what a successful client looks like. How do we grow them? How can we grow them profitably? All of that hard work that goes into building a service business that can serve sellers better is exactly why you did a lot better. One question in there, Tyler, you mentioned Traction EOS. Can you break that down for us? What are we talking about there?
So if you're more than a solopreneur, even if you've just hired one VA, and if you've never read Gino Wickman's book, Traction EOS, it stands for Entrepreneur's Operating System. I just think it's probably the simplest. If you kind of think about a business, like I need a filing cabinet to organize how do I put people in their place? How do I put my processes in place? How do I make it to where I can actually scale beyond just how many plates I can spin, right? That's the reality of every startup CEO, is that we feverishly spin plates until a few of them drop, and then we either drop plate that kills us, or we're able to weather that adolescence and bring people onto our team and scale. And I would say that for me in both of my companies, and man, I wish I'd have done this 2 years earlier in my first company, but the reason we were able to get that first company in order and get it to exit was that we got organized. So it helps you get, I am not a great manager. I wish I was, Jason. I'm a good visionary leader, but I need a system to help me create accountability for my team. And EOS is the system that we implement as a company.
That's a great share for our seller listeners out there, our young entrepreneurs. Thank you, Tyler. Okay, all that's fine and good. Yeah, get your house in order. But there's the R word out there right now, Tyler. The R word is coming, and all these CEOs are doing layoffs, and they're terrified about a potential recession. What is your mindset as an entrepreneur, as an advisor to entrepreneur-led businesses, when maybe or maybe not, I don't know, maybe the hard landing, soft landing, whatever, whether that recession comes? What's your advice in this environment, Tyler?
Having some anxiety about a recession forces us to do the thing, Jason, that you and I should have been doing anyway, which is we have to think enough ahead to say what would happen if the business went down a little bit or if interest rates went up. And a lot of sellers that we work with, when they actually take a look, realize, whoa, I'm running things kind of on a flimsy, volatile level. It doesn't take a whole lot to go wrong for my business to be toast. And so the market has my attention now, and it should have your attention, to say, let me just take a look at my expenses. Wow, I'm paying for 17 different e-commerce support tools, and I've only logged into one of them in the last 2 weeks. Okay, now's the time. We got the motivation. Let's go ahead and cut some expenses that we don't need. Sally, I really like Sally because she's my brother's girlfriend, and she was doing the stuff for me in the back office, and I know she's not a good fit for my team. Well, guess what? Now I'm feeling the pain because Q4 was hard. We love you, Sally. We're going to help you find something else to do. And so I think that's the first thing is take the feeling of pain to do the work that you need to do as a CEO. And then the second thing I would say is the thing that's made Warren Buffett, I'm reading a great book on investing right now called How to Invest by David Rubenstein. Super nerdy finance book. Read Traction first. Don't read that one. But it's interviewing all of these contrarian investors that always look to buck the emotions of the market to say, wait a minute, no. The bear market is where I make my money. That's when I have the opportunity to try to find those right investments and expand. The bull market's when I need to be cautious. Right now is when I need to go for it. And so I think that's where my mindset is.
I couldn't agree more. And in my time, I've been through a lot of recessions, even the Great Recession in 2008. And we did exactly what you talked about. Stuff that when we looked back on it, we should have done before the Great Recession anyway, because that's what good businesses do. But we went in, we trimmed the fat, we made sure we had the right people on the bus. And at the end of the day, we gained market share. Every time there was a downturn, we gained market share. Why is that? Because we kept our growth mindset, continue to grow and increase sales velocity and turn inventory. But we also noticed during those downturns that a lot of our competitors that were a real thorn on our side just disappeared or vanished because they didn't do the things that we had done, and they weren't still thinking with a growth mindset. So I completely subscribe to what you're throwing down there, Tyler. Great stuff. If you dusted off your crystal ball here for a second and you say, look, here's 2023 is coming. We're early in the year. What do you see that's coming for sellers? And is there anything out there that you think folks maybe haven't thought about that they should be thinking about that we haven't covered in today's episode?
Part of the forecast we already talked about. Now's the time to get your house in order and to place your bets and be growth-minded and contrarian in your mindset. Now's not the time to sell, and I forecast that'll continue to probably be the case for the next year. So listen, if you're burned out, you got to get out. But I think if you have enough gas in the tank to continue getting better and to continue growing. I don't know, Jason, I'm not trying to be super optimistic here, but I don't think we're going to have a major deep recession here. I think we're going to continue seeing some headwinds. Interest rates will probably go up, in my opinion, 2 or 3 more times over the next few months. By the way, the flip side of saying it's expensive, it just means we need to be more proactive. We need to be more proactive at managing our assets, and we may have to slow down growth. I will say that 2023 for me and for our sellers, the mantra is profitability. Sales has always been vanity, but right now it's definitely vanity. Profit is sanity. Bezos is going to get his 45 cents out of the dollar. He's going to fund another penthouse somewhere. He's going to be just fine. We don't have to give him any
build
more
another
than we have.
rocket.
Let's keep some money and let's make sure that we're profitable this year so that we can really make this the best year ever.
Profitability doesn't necessarily mean get the biggest gross margin. It also includes turning fast. It also includes sales velocity. It also includes managing that cash flow and that return on the dollars that you're putting in to all the way down to each individual SKU and all the way back up on your top line. So great advice. Tyler, if folks want to reach out to you, if they need help getting their financial house in order, what's the best way for them to reach you?
Yeah, if somebody's looking for bookkeeping or fractional CFO, SellerAccountant.com is a great way to find us. You can find me on LinkedIn, YouTube channel, and we'd love to talk to you.
Awesome. And he's selling himself short, folks. He's a true business strategist and advisor. That's your DNA. I can feel it. And it just so happens that he's damn good at CFO, bookkeeping, and the controller type stuff as well. And is amazing at building great teams. So Tyler, thanks a million for being here. We're going to have you back.
Thanks, Jason.
Recapping, folks. Yes, Amazon's raising fees and that sucks. But compared to other channels where you're paying for Google or Facebook traffic or a warehouse and Bob to pick and pack and ship for you and UPS and FedEx, Amazon isn't a bad gig. We would like to lower fees. Would we like to? Hell yes, but you have to be there for no other reason. Defend your brand and get that cash flow and get that velocity. Recession may or may not be coming. I think I'm aligned with Tyler. I don't think it's going to be such a bad thing, but get your house in order. And if you're not sure, if you don't know a P&L from a packing slip, reach out to Tyler, and he gave a couple ways for you to do that. Lastly, folks, if you're ready to start growing and protecting your brand on Amazon with a team of experienced Amazon operators, you can visit us at day2podcast.com. That's day2podcast.com. If you know of anyone else who would gain value from this podcast, and let me tell you, folks, this one was jam-packed. Listen to it more than once. Please share it with them. Thanks for listening, and happy selling.